Good evening. We are Group 10 and will present today our analysis on Qurate Retail Group. Our group recommends selling Qurate at a price target of $5.9, suggesting a downside of 23%. There are four drivers that underpin our sell rating. First, Qurate's customer base is aging, with 90% of customers being 35 years old and above. Second, we believe that although Qurate has a strong position in the home shopping market, it lacks a competitive advantage in the highly growing e-commerce market. Third, Qurate shows low potential for international expansion and is showing weak liquidity and asset turnover. So going into the company overview, Qurate Retail, formerly known as Liberty Interactive Corporation, sells various consumer products, primarily through live video program, websites, and applications. It's comprised of four operating companies, QVC and HSN, which focus on marketing and selling products through live video programming. Zulily and Cornerstone brands, which focus mainly on online and mobile sales. QVC drives the group revenues, with US sales representing 46% of total group revenues and international sales representing 20%. Its product mix includes home items, apparels, beauty, and other consumer products. Now, when we look at Qurate Retail's stock price and performance over the years, we can see that the stock price has been highly volatile, with the stock price going down from $29 in 2015 to $7 in 2020. From the period of 2015 to 2020, Qurate acquired Zulily and HSN to consolidate its product offering, but mismanagement of synergies led to poor quarterly earnings in the past years.
Moving now to the main linchpin issues, we noticed that there are four main linchpin issues. First one touching on the customer base, the second one touching on Qurate's positioning within the market, the third one touching on Qurate's international presence and geographical expansion, and the fourth one, liquidity and solvency situation. We're going to deep dive into each one of them. The first one is about customers. The main profit engine of the company is its existing customer base, a category that constitutes 52% of the total customers, but accounts for 87% of shipped sales. This category is comprised of very loyal customers, aged 35 and above, and predominantly women. On the short term, this category is a gold mine for the company, as high retention rates combined with high purchasing power drives profits. On the long run, however, the rate of exit of this cohort is expected to exceed the rate of entry into this category, meaning 10, 20 years down the line, millennials and Gen Zs won't be the typical Qurate customer, since those generations were brought up shopping on Amazon and the like. We believe that this is not properly factored in the stock price, as all the analysts and the company itself emphasizes strong retention rates, which are indeed strong, but belong to a customer base that is gradually disappearing. Only looking at historic retention rate is misleading. Customers age 18 to 34 are mainly interested in the e-commerce offering of the company and have a higher risk of switching to competitors, mainly Amazon. New customers, they constitute 70% of the new customers are concentrated in the 35 plus age group, which is expected given the company's offering. However, those new customers have a very low retention rate compared to industry average, and as such do not contribute immensely to company profits unless they become frequent shoppers. This is the same as for reactivated customers, who, similar to new customers, do not contribute immediately to the company's revenue. Now moving to the next linchpin issue.
Okay, as we know, Qurate is playing in two segments, the home shopping and the e-commerce. We believe that Qurate has a strong positioning in the home shopping, as we can see from the competitive landscape in next slide. Qurate is a market leader in home shopping, if you look at the top right corner, with its brands HSN and QVC. Also, the company has a strong brand, which is associated with reliability and quality, and a loyal customer. If we go back, we notice that, however, this market where Qurate is strong is flat and is not expected to grow. Differently, if we look at the other market, being e-commerce, we notice that this is growing very fast. This is growing double digit. However, Qurate has no competitive advantage in e-commerce. And looking at the competitive landscape again, we can see that the landscape is very busy with big players such as Amazon. Therefore, we do not believe that Qurate is able to compete here. And also looking at Zulily, which is supposed to be the flagship e-commerce brand for Qurate, we can see how Zulily has been underperforming with decreasing revenues and revenues per customer. So if we go back last time, we can see that this basically Qurate has a strong positioning in a flat and not growing market, while it's weak in a high potential market. And this combination leads to decreasing revenues both in home shopping and e-commerce. Okay, we also believe that Qurate has low potential to expand and thrive internationally. Qurate is already present in some markets outside of the US, UK, Germany, Italy, and Japan. And in Europe, we can see how the market is expected to shrink. So we do not believe that Qurate can be sustainably successful here. Also, looking at the example of France, we know that Qurate shut down its operations in this market in 2018 due to low financial and operational performance. So we believe that this could happen also in other markets in Europe. Looking at Japan, Qurate is playing here and it's a big market. However, it's not supposed to grow in the future also. The only market that's expected to grow is India. However, we do not believe that here Qurate could be successful in case it decides to enter, because the market is highly concentrated and there are 4 players making 80% of market size.
Moving now to Qurate's liquidity, we noticed that the company's short-term liquidity is subpar compared to its competitor. By viewing basically the cash ratio and the quick ratio, we noticed that it's not doing very well. The company has a very low capital intensity ratio and is thus not using its assets properly to generate revenue. On the long-term solvency front, the company seems to be healthy. They always have enough buffer to cover the interest expenses on time. So finally, an issue that runs across all linchpin issues is the company's list of shareholders. Most importantly, the shareholders with voting powers. Although the Qurate A stocks are predominantly held by institutional investors who, for the most, did not sell material parts of their stocks in the last 5 years, we noticed that 45% of the voting rights are held by company directors, and the majority of the 45% is held by one person, John Malone, the director of the board. This concentration of voting rights, in our opinion, makes it hard for nimble and strategic decisions to be made, as institutional investors cannot put as much pressure as they want for transformation. And now Paolo will take us through the valuation and scenario analysis section.
Okay, sure. So jumping into the revenues, if you just look from a top level, you would believe that revenues have been growing and there's a big jump from 2017 to 2018. But in fact, all of the revenue has been driven by acquisitions. And if you look across each business unit, we can see that growth is extremely small. For example, QVC in US has been growing only at a 0.14% rate. HSN, which was acquired in 2018, actually went down 3.2%. And Cornerstone as well went down by 11%. So in general, revenue hasn't been growing. It's been stagnant even with acquisitions. On the next slide, digging deeper into the cases and how we reached our valuation. So what we did is we took 6 scenarios, bear, downside, base, upside, and bull. And for each one of them, we had key assumptions on how we expected both the market to be and Qurate to play in their respective market. For example, in the bear market, we assume that customers and revenue will decline at 3%. Synergies across all the acquisitions are going to fail to realize, and they will not have the ability to differentiate themselves in the e-commerce market. Given these assumptions, the price is going to be for the bear case 3.3 with a downside of 57%, and we give that a probability of 15%. On the downside, it's very similar to the bear. The only difference is that it's declining at 1% rather than 3%, and some synergies begin to work. And in this case, it's $4.5 with a 41% downside based on a $7.6 current share price. For the base case, which is what we believe will be the most probable one, we assume that it's going to stay stagnant, revenues are not going to grow. There's going to be some synergies that will work, but they still won't be able to succeed in the e-commerce market, and this puts the stock price at 5.3. On the upside, revenues are going to grow at 2%, synergies will be realized, and they still won't be able to differentiate in the e-commerce. And this puts the price at $8.1. And finally, in the bull scenario, we expect growth at 3%, synergies are fully attained, and they'll be able to be a key competitor in the e-commerce market, and this puts the price at $15.2. Doing the average of all of these with the probabilities, we conclude that the share price is going to be $5.9, which is 23% below the current price share. And that sums it up. Thank you, and you're welcome for questions.